As Ms. Nanu Bashir mentioned in her initial remarks, it is a welcome development. The JPMorgan said in a note they put out on September 21st that they will start including Indian bonds from June 24, and over a period of 10 months or so, it would reach the maximum weight of 10%. And that currently 23 government bonds are eligible with a combined nominal value of $330 billion. And India has been on the watch list, both in the JPMorgan Bond Index, emerging market, and FTSE Emerging Markets Global Bond Index. Some brokerages estimate that at nearly $1.2 trillion, the Indian government bond market is the third largest among emerging economies after China and Brazil. But of course, we all know that the foreign ownership is currently less than 2%, one of the lowest compared to other emerging markets. And so far, the probable reason was that India was a notable exception among the major emerging markets, that it did not feature in global bond indices, and this development will rectify that exception. It was first announced in the budget speech for FY22 in February 21, and the discussions had started in 2019. And after that, I think the controls on foreign investment have been released February 21. Those who are not speaking, please do mute your lines, please. Please remember to mute your lines. The discussion for inclusion of government securities in global indices started in 2019, and thereafter the controls were relaxed gradually. To enable smooth inclusion, the Reserve Bank of India had announced 5 securities maturing in 5, 10, and 30 years in March 2020. And these securities are to be available to foreign investors without any limits. And I think it is now 5, 7, 10, and 20 and 30. Under the scheme, eligible investors can invest in specified government securities without being subject to any investment ceiling. And SEBI also has simplified the procedural requirements. Now, the RBI report on the interdepartmental or interdivisional group report on the internationalization of the Indian rupee, in page 36 of that report, had actually quite elaborately mentioned the advantages and the areas to watch out for when India gets included in the global bond indices. Obviously, the investor base for India's Indian government bonds widens, and it will also, in a way, relieve the Indian financial institutions from having to be one of the biggest buyers or subscribers to Indian government bonds, and they can actually then lend that money for more productive purposes to private sector or the commercial sector or individuals, etc. So, and naturally, the financing of the current account deficit becomes that much easier, because it is by and large believed that these investors are long-term and patient investors, and they are not fickle or hot money flows. So these are all the stable passive flow. These are all the advantages that we all know about. But naturally, and there are various estimates, exceeding $20 billion, ranging from $20 to $26 billion would come in, and then overall, and then over time, it would steady. Naturally, it also increases. There are also challenges to keep in mind. It increases the sensitivity of domestic policy to external spillovers. We need to keep an eye on what foreign investors would be thinking, what will happen to bond yields, currency, etc. And sometimes during globally uncertain times, unrelated to Indian macro fundamentals, there could be volatility in the Indian bond market or in the currency because of the inclusion or the holding of foreigners or holding of Indian GSEC by foreigners. That is something we need to be prepared for and prepare us, and also think about it accordingly. And naturally, therefore, fiscal and monetary policies need to be cognizant of the global perceptions and sensitivities. And there could be also potentially, I'm talking in the conceptual or theoretical framework, potential cost of sterilization and associated market operations will also have to be kept in mind because of global perceptions and sensitivities. But by and large, at this point, we welcome this development because the benefits of index inclusion appear to outweigh the concerns and challenges which other countries are also facing. And we need to also balance in the long term the portfolio or the foreign investor flows along with macro-prudential considerations, because ultimately, while foreign investors are looking to invest in India for its macroeconomic policy stability, the very act of their investment interest should also not jeopardize the macro stability. So to that extent, macro-prudential policies will also become critical down the road, if not now. Just as portfolio investors in equity markets in India have benefited over the last 30 years from their investment in Indian equities, even in dollar terms, on risk-adjusted basis, Indian equity market, if you look at the Morgan Stanley Capital Index, it has delivered positive returns on a risk-adjusted basis better than the MSCI emerging market indices or even the all-country world index, etc. So similarly, we believe that long-term patient investors into Indian government securities will also benefit in terms of earning for themselves commensurate economic returns. These are my initial remarks, and the floor is open for questions. Thank you very much.